Understanding gains and losses. Portfolios go up and down over time relative to how they're invested. More aggressive portfolios are more heavily invested in equities or the stock market. More conservative portfolios have a higher allocation of fixed income investments, the bond market. As we experienced in the first half of 2022, risks associated with both the stock and bond market can negatively impact portfolios and create losses. Conversely, the markets, both stock and bond, can benefit and experience gains when conditions for growth are favorable. For example, in 2021, the S&P 500 gained over 28%. That was after double-digit increases for the market in 2019 and 2020. For investors saving for retirement, not just to the date they retire, but all the way through retirement, these 3 years of growth in their portfolio were meaningful and are considered unrealized gains. They're unrealized because as a long-term investor, you didn't sell your holdings to realize those gains. In the first half of 2022, the S&P 500 declined almost 20%, and the bond market was down as well. Again, as a long-term investor saving for retirement, this is considered an unrealized loss, assuming you maintained your long-term view and did not sell. If you did choose to sell, you would have realized these losses created by this market correction. The primary goal is to understand the difference between realized and unrealized gains and losses. Unrealized gains and losses are losses on paper. Realized gains and losses impact the true value of your account. The emotions fear and greed can cause some folks to do the wrong thing at the wrong time. Selling in June of 2022 and realizing losses in your portfolio would be an example of that. But for the purpose of this video, the primary goal is to understand the difference between realized and unrealized gains and losses. It's important to take into consideration the type of account you're invested in as well. In a tax-advantaged account like a traditional IRA or 401k, there is no tax consequence when gains or losses are realized. In taxable accounts that can incur tax consequences from one year to the next, realized gains and losses must always be taken into consideration. Maintaining a disciplined approach with your investment strategy based on your goals, your risk profile, and your plan for retirement will help to prepare you properly for your retirement years.